What's up, guys? Back with another video to add to this series. I hope you guys are doing fantastic. Let's get right into it. So today what we are doing is something that is very important in our trading analysis, and that is sweeps of liquidity, or you could also call it liquidity raids. So essentially what this is a deliberate move by the algorithm driven by institutional order flow to engineer liquidity or below highs and lows. Basically, it's not really just a random spike. They're really just trying, it's really the algorithm trying to fill institutional orders and then move it to other orders to fill at a higher price so they could cash out their orders and make a profit. It's drawn basically. It draws. It uses. You could use highs and lows as a draw on price, and expect it to get swept. So you could use basically highs and lows as a target essentially to when you're in a trade. So if there's a double high, a double top, you could call it too, whatever it is, but let me get the drawing tool. There's a double high like this, and market swept this low here, for example, then you could expect us to come up here, especially if we're in a uptrend. If we're in a downtrend, then it's possible that we just go around like 50% of this leg, and then we end up heading back lower, and essentially probably sweeping a high in here, filling an imbalance, and going lower. So that's not really what I want to be talking about, filling an imbalance and sweeping a high internally. Yeah, I don't really want to be talking about the imbalances yet, guys. That's coming later on in the series. I think it's the next video, matter of fact. So definitely stay tuned for that. Perfect. All right. So next thing, guys. So there's two different types of liquidity rates. Really simple. There's a buy side liquidity raid. Buy side. So buy side of the curve liquidity rate right there, buy side, and then there's a sell side right there. Super simple. When you see equal highs and equal lows, those end up being a magnet, and if you have it with the daily bias, so if you're bullish, then the highs will most likely get targeted. You could use it, you could call it like a magnet or whatever, like the draw on liquidity. Essentially that's what I use the double highs and double lows for. Of course, there's a triple high as well. That's an even better magnet. And if you're bullish, you can definitely see us come take the highs. And essentially, what do you see in this chart? See high, low, high, low, high. We keep taking out the lows. So it's like, okay, so right before we took this high out, we swept liquidity. Okay. Now let's see if this is basically where I would take a trade after you take liquidity. And essentially, this will also happen in a kill zone, which I mentioned before last video. In a kill zone, which means that it's within the time frame that I gave you guys last episode, basically. So you would take a trade here and just expect us to take out this triple high as well as the triple low, like that. Okay, well, there we took out the low. Give me 1 second. Something like this. Take out the highs. If you're bearish, target the lows. Take a trade up here. Target the lows, and you're out of the trade. Simple as that, guys. Not too much to it. It's fairly simple. All we're talking about this video is basically understanding liquidity rates, what they are essentially. Like, this is basically the basic principle, like the structure of our trade essentially. This is the start of the confirmation that we want to reverse, and then to target opposing liquidity in which we would want to target in our trade. This is basically the start of that confluence train, you know what I'm saying? So how do I identify these relative equal highs or equal lows? It's essentially just two here. We'll go on the market really quick. Something like this. Equal highs there. Ran through. Everyone got taken out. Absolutely got obliterated because it gapped up. So they actually, instead of getting taken out over here, they got taken out over here. So that's unfortunate. Equal lows we have right there. Equal lows there. Snapped down. Equal highs. Snapped up. Took that out clean. Equal lows. See, guys, they don't have to be like super equal. Like, this is close enough. like I wouldn't really consider this equal lows, but this is close enough. Equal lows. This is kind of equal highs, not really, but it's an uptrend, so this ends up being a high probability target since it's also a Tuesday high. So Wednesday comes up, absolute snatches Tuesday's high after we also take out Friday's low of the previous week. So it's very high probability trades here, especially because it's a double low. And we also filled in this, well, not filled in, but we partially filled in this imbalance here. So we don't want to get too much into imbalances, guys, but we touched it and just flew. Yeah, so these are equal lows pretty much, but it got taken out, so it's like a low probability equal low. What I mean by low probability equal low is because if we already take it out here, of course they're like still pretty equal, right? But we already took it out here, so it's like if we're up here and we took out this high and we start breaking structure down to the downside, targeting this, if we're like, let's say in a bearish trend, it'd be like, okay, it's not bad, but it's not as high probability as if this low was higher than this one. Because what I'm saying is we already took liquidity out here. So if we came down and snapped below this low, the chances of us filling this gap is even higher. The chances of it heading even lower is higher, because it's like, why would we want to come for this low? Like, it's not as high probability. So if we do, and in turn come for this low, it's like, okay, then we're definitely bearish on a higher time frame. Maybe coming to seek for this low, filling in the rest of this gap. That's what I'm saying, guys. It's like, it's really a probability game. Like, these two equal highs, these are relatively equal. Get snatched right here. Well, we snatched one, and then so now it's, but we're also in an uptrend, so we already snatched that, came down, snatched this low. What can you expect? This high and this high to get targeted. Absolutely snatch, as well as this one. So guys, it's really all probabilities, and it's same thing in this scenario goes for the highs. If for example right here, y'all mark both of them out. So as you can see, this wick came lower, so this candlestick, essentially its low was lower than this low, snatched liquidity there, filled in orders here. So as you see for the highs, same exact thing, guys. High here, this high of this candlestick was higher, snatched liquidity, came lower, snatched this side, sell side. Then we essentially came up, broke structure to the upside, boom. Not going to talk about that in this video, guys. It's in the next video, guys. So, and then we essentially come up for the low probability equal highs. What makes this a higher probability equal high than this one? Now, guys, this is where we're getting into like a bit like advanced stuff here, but it's so simple, guys. It's really so simple. It's just relative to what we have been talking about, it is pretty advanced. Like, we've been talking about baby food stuff, guys. This is a little bit next level. It's not super up there, but it's definitely a little bit of a learning curve for you guys. So if you guys have any questions, just comment down below, right? So what I'm saying here is, why is this equal high more high probability than this one? It's because, first of all, first thing, we have trend. Okay, trend, we were going higher. Okay, cool. Where does that confirmation start? Right here. All right, break a structure, guys. Break a structure right here. Cool. Next thing, we took that out. Okay, that's cool. But we also have this high. These are relatively equal highs now. These are pretty close. There we go, guys. Not bad. But what else do we have? We also have these equal highs here. These two little wicks. Those are equal highs, guys. But what do you also see in these equal highs? Boom, liquidity sweep here on the lower time frames. You can't really see it that well on the higher time frames here, guys. I'll go to a lower time frame. Oh, where is it? Okay, maybe lower. Right there. Perfect. So essentially, came up high, came lower, fake move to the upside, swept liquidity right there. Guys, this game is a bunch of sweeps of liquidity, guys. So all you have to do is get in line with the trend, with the sweeps of liquidity, which PD rays are holding, and you're good. And it all becomes probabilities from there. And how, of course, you manage your emotions in stressful environments. And what I mean by stressful is when you're putting money up. when you're doing demo trades, it's not very stressful. So it's your emotions don't come into play as much. But when you're trading with little money, then that's it. Definitely will take a hit on your emotions. It'll be a different kind of challenge, guys. So essentially, come up, take high out here. Also, is this one as well? Snap lower for these lows. Hey guys, that's all it is, guys. It's basically a game of sweeps of liquidity. Where did we sweep the last higher time frame liquidity, lower time frame liquidity? Like that's all it is, guys. And then which PD rates are holding? Do we rebalance to equilibrium, guys? It's all coming in the future. Just stick with me. This is we're already getting a base of our structure of how we trade, guys. This is how the markets move, right? So also again, why is this higher probability? This basically lineup of liquidity. Why is it higher probability than this? We also have this here, this big candle here. Yeah, so this big candle here, did it get filled in? Here, I'll draw it out. This thing get filled in, guys. Again, I didn't teach it to you, but it's just to tell you guys right now for in advance before we start getting deep into this stuff. Did we fill it in? No, we filled it in here, but this portion here got left unfilled, meaning there's resting orders there. What kind of orders? Buy orders. Now, again, we're gonna get into this later. I'll go into depth later on, so definitely stay in tune for that. So yeah, we basically filled that, and yeah. All right, so guys, we'll go over quickly the main points of liquidity raids. So we use liquidity raids to essentially it's the starting point of your entry model, okay? Second thing, we use it as targets to target opposing liquidity because that's where markets want to go to fill orders. That's pretty much it for liquidity on like how we use it. It's just targets and literally just like more reform setups. Also, you could like plan reversals on it and not really take a trade based off the liquidity raid and take it off of like a continuation play. So a silver bullet type of trade, but we'll get into that stuff later. That's pretty much it for liquidity raids. There's a couple confusions that people have with liquidity raids. Some people believe that like okay, basically liquidity raid is like when this happens, like a reversal. It's not this. This isn't really a liquidity raid. This is like a continuation move. So if you were to expect this to be a liquidity raid, you try and wait for liquidity and see here you trying to go short because there's like a fake out that goes down a little bit. See this wick because it looks a little bit like small because we're on like a higher time frame, but let's go smaller time frame. You guys will see that it'll like fake you out. It'll like take out the liquidity. Of course, it'll retrace a little bit, but then reverse back higher, taking out all those people who tried to go short at that high. So not every high or low is going to be a reversal point or a trade point. So keep that in mind, guys. Like this one, I absolutely ran through, so it didn't reverse like this one or like this where it came up. This one like barely reversed, but like this right here, little low, swept, gone. Lows, swept, gone. High, swept, gone. Highs over here, swept, gone. Stuff like that, because some get ran through like this high right here, ran through. Some people probably went short there, but then got stopped out, you know. So some highs and lows aren't always going to be liquidity rates, which come with reversals. So we'll go over the higher probability and lower probability targets, like draws for price to like draw to. So we have the higher probability, which is here, I'll just draw them out for you guys, super simple and quick here. So high probability is all of these triple top, double top, ones like this too, but this one's a bit lower, but it's essentially all high probability. And obviously like a singular high is high probability as well. These are a bit lower probability draws. I'll do the same. I'll do buy side as well because also might confuse you guys. So this is lower probability, something like that. So this draw there we go. So like for example, this would be a lower probability draw if we were to come up lower probability to target this. This one too, because we already swept that. What else? Like pretend there was like an imbalance here to get filled. If there was no imbalance here, it was just a random high, no imbalance here, this would be higher probability. So yeah, guys, that's pretty much it. It's fairly simple. This is basically a liquidity rate is basically the starting point to our entry model to target and reverse to opposing liquidity to follow and continue the trend. That's pretty much it. It's as simple as that, guys. It's not too there's not too much to it. Of course, there's a couple more concepts to our strategy, but when it comes to liquidity raids, that's pretty much it. Yeah, I think that's gonna be it for this one, guys, and we'll catch you in the next one. Peace.